Good morning, hunters. Welcome to the Daily Hunt for Multibaggers on this Thursday, April 2nd, 2026.
That's right, Ethan. We've got quite a packed episode for you today, diving into the data collected yesterday, April 1st. Our AI flagged a significant number of posts, and we saw quite a few distinct companies come up for discussion.
Yeah, it was a busy one, Brooke. From what I saw scrolling through, there was a real mix out there. Some strong bullish pushes on a few names definitely catching my eye.
Well, and from my perspective, Ethan, while the market chatter highlighted some exciting potential, our deep dive into the KPIs for many of these stocks definitely revealed some serious points of caution. It's a real tug of war between speculative optimism and fundamental realities out there.
All right, let's jump right into our first candidate, Mosaic Company, stock symbol MOS. Now, there was some talk, about the fertilizer trade still being early, potential supply shocks. The buzz was definitely looking for an uptick there, seeing some opportunity for MOS.
Early, Ethan? Our analysis showed a pretty bearish overall sentiment. Users were quick to point out that past fertilizer surges didn't lead to sustained gains for MOS, and the KPIs, their net profit margin and operating margin are quite low, which directly supports the concern that higher input costs like sulfur or gas could just eat into any potential profit, even if fertilizer prices rise. We actually had a speculative gamble rating for MOS back on March 24th, but the current data just doesn't support even that.
So despite the potential for rising fertilizer prices, the company's underlying financial health isn't showing the muscle to capitalize on it, huh?
Exactly. With such thin margins and specific questions about their product mix, it feels like an uphill battle. My AI-generated insights definitely say stay away from MOS right now. It's a clear downgrade from our previous speculative take.
Understood. Next up, a company that always gets a lot of chatter, Rocket Lab Corporation, or RKLB. The discussions were strongly bullish here, Brooke. People were defending RKLB's capabilities, their track record, major government contracts, like that $890 million deal from the Space Development Agency. There's a lot of excitement for their future, especially with the Neutron rocket.
And I get the enthusiasm, Ethan. They do have that impressive 35.7% revenue growth, and it's exciting to see a company in such a cutting-edge sector. However, when you look at the financials, RKLB is deeply unprofitable, with a net profit margin of negative 32%, and the debt-to-equity ratio is at an alarming 15.395. That's extremely high leverage for a company that isn't turning a profit yet. Plus, we saw significant net selling from insiders recently, which always gives me pause.
So even with all that positive buzz and future potential, the current numbers are just too risky for you. It's been a stay away many times before, with a few buy or speculative gamble sprinkled in.
For me, yes. The current valuation with such significant debt and unprofitability means a lot of future success is already priced in. While the potential is there, the risk profile is just too high at this point. So for now, our AI-generated insight for RKLB remains stay away.
All right, moving on to another space-related name, Firefly Aerospace, or FLY. The original post made a very bullish case, talking about 170% year-over-year revenue growth and no meaningful debt, positioning them as a high-margin defense tech platform. Sounded promising, right?
Oh, it sounded promising, Ethan, but those numbers were starkly contradicted by the actual KPIs. Our data showed revenue growth at a much lower 5.384%, not 170%. And the debt-to-equity ratio, it's a staggering 25.934, indicating extremely high leverage. They're also deeply unprofitable, with a negative net profit margin and EPS. Comments even highlighted their low launch success rate.
Wow, those are some pretty big discrepancies. So that initial hype didn't hold up under scrutiny. This is the first time we've discussed FLY on the podcast.
Indeed. While the insider buying is a positive signal, the current financial health, coupled with the wide gap between the bullish narrative and the cold hard numbers, means a stay away for FLY right now. We need to see significant improvement in those core financial metrics before considering it.
Okay, shifting gears to W&T Offshore Inc., or WTI. The post was about someone making a big profit on WTI crude oil futures, benefiting from geopolitical events. That sounds like a winner to me.
A winner for the commodity, Ethan, but the trader themselves explicitly said it wasn't worth the risk or stress and planned to return to long-term investing. The company WTI, the stock, paints a very different picture. Their net profit margin, earnings per share, operating margin, they're all deeply negative. They even have a negative price-to-book ratio, which suggests their liabilities might outweigh their assets.
So the underlying company isn't benefiting from oil price surges in a sustainable way, and the original poster's experience actually argues against chasing high-risk plays. We've rated WTI as stayed away before, most recently on March 16th.
Precisely. The minimal revenue growth and severe unprofitability make this a very risky proposition, despite any commodity price volatility. The AI-generated insight is to stay away from WTI. No change there.
All right, let's talk about Automatic Data Processing Inc., or ADP. We saw a report about U.S. private payrolls showing better than expected growth. Now, for a company like ADP, that sounds like good news for their core business, right?
On the surface, Ethan, yes, but the user sentiment was overwhelmingly bearish on the quality of that job growth. Most gains were concentrated in education and health services, with users expressing concern about sustainability and job losses in other key sectors. And the stock itself is trading alarmingly close to its 52-week low. Their debt-to-equity ratio, as presented, is an incredibly high 70.044, indicating significant financial leverage.
Wow, that's a lot of debt. So even with a seemingly positive jobs report, the underlying concerns about the economy and the company's own financial structure are outweighing it? We've classified ADP as a stay away several times, including recently on March 5th.
Absolutely. While they have strong profitability metrics, that high debt coupled with the macroeconomic skepticism from users and professional analysts trimming price targets makes it too risky for now. My insight is to stay away from ADP.
Last but certainly not least, let's discuss Microsoft, or MSFT. The user who posted about their gains was explicitly bullish, holding both shares and calls, which is a strong signal. And honestly, I continue to be bullish on MSFT. Their investments in AI, the continued expansion, the core business strength, it all points upward.
I have to agree with you on MSFT, Ethan. While there was some minor insider selling and institutional trimming, the core KPIs for Microsoft are simply outstanding. We're talking about a net profit margin nearing 40%, revenue growth at 16.7%, and an incredibly strong return on equity. The current price is actually closer to its 52-week low, which for a company with such robust fundamentals and clear growth catalysts like AI and massive infrastructure investments could actually represent an attractive entry point. We've seen MSFT buy consistently, including just yesterday.
Exactly. Despite the general market noise, Microsoft's fundamentals are just too strong to ignore. Our AI-generated insight for MSFT remains a solid buy. All right, Brooke, let's wrap up our thoughts for today.
Happy to, Ethan. It was certainly a day of strong opinions and stark financial realities.
And that wraps up another episode of the Daily Hunt for Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions.
We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in.
We'll catch you tomorrow for another hunt.